welcome to the deep dive. So for today's mission, we cut through all the noise to really analyze the market sentiment from your source materials. And the picture we found isn't a simple one. It's this deeply split path where investors are, on one hand, being super cautious, and on the other, placing some extremely aggressive bets. It's a strange mix. Let's unpack this.
It is. That cautious part is, I think, the definitive finding. We're in what you'd have to call a major transition phase. And the key thing here is this really intense winner-takes-all vibe. But it's coming from a place of, deep uncertainty. The market looks strong on the surface, but that's just a few big names. Underneath, there's a lot of fragility.
That actually brings us right to our first section, what we're calling the Tale of Two Cities. So city number one is the big tech squad. The sources just show this massive concentration of money around a few huge names. We're talking Alphabet, Micron, TSM.
Right. And it's not just hype. It's a real flight to quality. These companies have immense cash reserves, high margins. They're just so defensible. Investors feel like they literally cannot afford to miss out on the AI story.
Yeah, exactly. But then you have city number two, which is on a totally different planet, the flight to what we're calling hard assets.
We're seeing a huge amount of capital flowing into gold, silver, and the mining stocks that go with them. And this is being driven by a really deep, almost structural worry that the US dollar might be losing some of its mojo. So people are looking for something real. It's a big psychological shift.
And here's where the tension is, right? The big index charts, they look fine. They look robust, but that's almost entirely because of big tech.
Right. Only because of them.
Yeah, the sources make it clear that the average company is really struggling. The median stock is underperforming. And that suggests the whole market structure is maybe a lot more fragile than it looks.
That fragility is the perfect bridge to our next section, because the economy itself is playing defense. The whole vibe has shifted from, not sure what's up, to, okay, things are getting a bit shaky. It's a classic late cycle feeling. You're seeing credit get tighter. Corporate earnings are probably at their peak. People are bracing.
So what's pushing everyone into that defensive corner? Well, it's inflation. It's just so stubbornly persistent. It's sticky.
It is.
And because those high prices are so dug in, investors are pivoting hard into what you might call boring stuff. Consumer staples like groceries, healthcare, the things you have to buy no matter what.
And you can see that same caution in how the big banks are behaving. You look at Goldman, Morgan Stanley. They're doing great. They're making money from trading, collecting fees, but they're basically ghosting the real economy.
Ghosting the economy. I like that.
Well, they're not rushing to lend cash out for broad growth. And that's a huge sign. So investors are now laser focused on companies that have actual cash in the bank, not just a good growth story.
That explains so much. It's the perfect setup for the gold obsession comeback. I mean, for years, gold and silver were just insurance. Now they're being framed as a must-have.
So the question is why? Why the sudden urgency? And it's really this mix of top-down and bottom-up anxiety. From the top, you have central banks all over the world quietly buying up gold in huge quantities. That's a massive signal.
Huge signal, yeah.
And then from the bottom up, you have investors just getting really stressed about the national debt. These hard assets are seen as protection, sure, but here's the key. They're also making money right now. They're not just a place to hide.
Okay, so wrapping this all up, what's the bottom line for you, the listener? It seems pretty clear. We're in a moment where the market is just demanding quality and defensibility. It feels like investors are making one foundational bet on big tech while also buying a ton of insurance with hard assets.
Exactly. So given that data-backed shift toward quality and this fragility we're seeing in the average company, here's a final thought for you to chew on. If cash and real assets are truly king right now, what other non-traditional real metrics or maybe overlooked sectors outside of just big tech and precious metals might offer the best long-term shelter? What is the true definition of stay safe out there for your portfolio in this kind of market?